So welcome everyone. This is Special Situations Ideas Forum. This is my third year organizing this at the New York Society of Security Analysts. Basically a case study group where we pick a topic and do a deep dive into that particular topic. So yeah, in summary, it's a case study group for adults and NISA members. And now, for the last 6 months, we have had this technology where we can invite experts in a particular topic and share their expertise with us. So great. And everyone can put their phone on mute while they're not talking. There's some feedback on one of the lines. Yeah, and that's great. No feedback now. So we're lucky to have Chris Mayer present Richemont to us, and I think as starters, let's go around amongst the panelists and introduce ourselves, and maybe Steve can introduce himself last and introduce Chris Mayer to the group. So my name is Vishal, and I run a small partnership, and I am the vice chair of Value Investing Group at the New York Society of Security Analysts. Anyone, Daniel, Chris?
I'm Daniel West. I'm a partner at Mars Lender West Asset Management in Raleigh, and we run a small investment partnership for ourselves and our clients.
Welcome, Daniel.
Thank you. Thank you for inviting me, Vishal. I appreciate it.
Chris Bloomstrand, Semper Augustus Investments Group in St. Louis. We run a partnership and separate accounts for high net worth and institutional clients. Look forward to the discussion on Richemont and to catching up with all you guys.
Welcome, Chris. Thank you for joining. This is the second time Chris is joining us.
Hey, Andrew Balcom here. I just a registered investment advisor in New York and look at a lot of value stocks, and happy to be here. Although I'm going to be popping in and out, so my apologies.
All right, welcome, Andrew. And Andrew is a fellow organizer of this forum at NISA.
Hey, I'm Thompson Clark. I guess I'll go before Stephen. I work with Chris Mayer at the Bonner Private Portfolio as head of research. Happy to be here and looking forward to the discussion.
Welcome, Thompson.
I'm Stephen, and I'm very happy to introduce both Thompson and Chris. And, you know, I think, so from a special situations perspective, there's probably no better, there's no more important aspect of the investment process than actually the flow of ideas and the flow of things crossing your pad. And I think we probably couldn't have scored better than with Chris and Thompson, because they've built their reputation on basically scouring the globe. I think the reason why we're probably friends is because of I focused ex-US, but Chris will just as much focus on US names than non-US names. And I think you can't, he's very, I love Chris and Thompson. They're both very well respected by a tremendous number of very phenomenal investors. And so what that basically means is Chris and Thompson are bringing to us, they're bringing us one idea tonight, but actually they're bringing us an entire, multiple years worth of scouring the globe for probably the best risk-adjusted return there is. And, I think we're going to talk obviously about Richemont tonight, and which is I love the title, Luxury at a Discount. I think it would be useful. I mean, after Chris goes through his remarks, we can open up the discussion more broadly, speaking about actually luxury companies, luxury valuations, the entire space. But Chris is very well published. He's written, his most recent book is 100 Baggers. And now he's actually putting his money where his mouth is. And he not only is a fantastic writer, but now him and Thompson are now managing a portfolio of ideas. And his new letter, the Bonner Private, I think it's Bonner Private Portfolio, right, Chris? Is basically, it's co-investing along with all of his recommendations. And there's no shortage of people who want ideas from Chris. And so we're so privileged to have both Chris and Thompson to speak to us tonight. So can I turn it over to you, Chris, now?
Oh, thank you very much, Stephen. It's a very kind introduction. Thank you.
Yeah, of course.
And thank you everyone for coming. I really look forward to this discussion. Thank you, Vishal, for inviting us to this event. So let's just hop right into it here. And just to give you an idea where we're going, what I thought we'd do is we'll go over a little bit of the basic thesis on the company and describe what it does. And then I'll hand it off to Thompson Clark in the second half. And he'll go through why the stock trades where it does and talk about how we think about the valuation. So also, in the interest of full disclosure here, the family office has a 2.8% position in Richemont now, 2.8% of the stock portfolio. So let me start a little bit by saying very quickly what we look for in a stock, and then we'll see how Richemont fits. So we look for great balance sheets. We don't knowingly take balance sheet risk, and if you look at our portfolio, you'll find a lot of under-leveraged, cash-rich firms. And we feel this is important to reduce the risk of a permanent capital impairment, which is really job number one for us at the family office. We look for a highly aligned management team, and the best test of that is really insider ownership. Not always, but usually. Makes intuitive sense why managers that have skin in the game would outperform their peers, and there's also a lot of empirical evidence to back that up. That's an important part of our process. And failing this, we really try to zone in as much as possible on the incentives in place. So, I always think of Munger's quip about what he calls the iron rule of nature. And he says that you get what you reward for. And if you want ants to come, you put sugar on the floor. So that's how we think that's very important, looking for incentives. And we look for quality business. So we're value investors, and value investors exist on a spectrum, as you know, and we're more on the quality end of the spectrum. So we're not likely to invest in, a burned out shipper or something because it trades for less than liquidation value, or trying to figure out whether Office Depot is a zero or not. We try to buy quality assets that we think there's a high probability that business is worth a lot more 5 years down the road. And last is the value. We want to get good value for our money. So we'll go through how we look at Richemont a little bit later. So let's look at Richemont quickly and just say, why we like it in brief, how it fits, and then we'll get into some particulars. So Richemont certainly fits the strong balance sheet criteria: cash rich, no net debt. It really has a lot of cash. 27% of its market cap is cash, and investments are about 19% net of debt. We're big fans of Johann Rupert, who owns 9% and controls the stock through super voting rights. And he's been a good steward over time. If you put a $5 with Richemont in 1988, it would be worth over $60 today, not including dividends and spinoffs. That's about a 9% annualized return. Again, not including dividends and spinoffs. He looked a lot better 2 years ago. I think the annualized return was about 13, but the stock's been almost cut in half in 2 years. We also, Richemont is a good business, which generates high gross margins and ROICs, and we'll see that a little more later. And we believe it has more room to grow, especially in emerging markets, places like India and Latin America. And in some ways, you can think of Richemont conceptually as maybe a bet on global wealth. And then we'll get into the valuation, which we'll tackle a few different ways. Richemont trades at the low end of its historical multiples. It's a discount to acquisition multiples for luxury goods companies. Some list of transactions we'll share with you. And we also did some discounted cash flow scenarios, which seem to indicate some substantial upside. So we'll get to all that. So let's look at, so what is Richemont? I think an easy business to understand. It's essentially a manufacturer of very high-end jewelry and watches. And so we think about what they make. I've got some pretty pictures in here. You know, they make Cartier watches, and these things are not cheap. Entry-level watches. I was just on the website before I did this just to see, and I think the cheapest one I saw was about $5,000. You know, some of them go for $50,000. The most expensive ones go for $100,000 and above. So this is very high-end stuff, and Cartier is their most important brand. Van Cleef & Arpels is another important brand of theirs. And here you see something that I'm sure is very expensive. So this shows you altogether, they have a portfolio of 19 brands. That may be hard to see, I'm not sure. But as you can see, many of them are over 100 years old. So we're talking about timeless luxury brands here. These are extremely valuable properties, and they are what give Richemont its wide moat and its ability to earn high gross profit margins and high ROICs. And we believe as long as these brands are managed well, they should continue to retain their luster. So let's look a little bit. The next series of slides I have just sort of highlights some important aspects of the business so we can talk about more as we go on. This breaks out the sales by segment. So you can see really what we're talking about is watches and jewelry. The other lines of business include things like apparel and pens, and they don't really make any money there. It's not really significant to the thesis. It's really about watches and jewelry. And it's really about jewelry, which jewelry makes up something like 80% of EBIT. So it may be worth pointing out here too that production costs are in Swiss francs or euros, so that question comes up sometimes. But I mean, the revenues are affected by the exchange rates, but over time, Richemont has shown it has pricing power and has historically maintained its profit margins even when costs are rising. This one here just shows you sales by region, so you get a sense for where they're coming from. About a third from Europe and 36% from Asia Pacific, which does not include Japan. And this is important and has been a source of problems over the last couple of years, which we will get to. Another point I'd like to make about this is that the sales by region are harder to interpret than you might think because, you know, say you have a Chinese buyer who goes to London and buys a Cartier watch there, those sales technically are logged as, you know, counting as a European sale, but in a sense, really it comes from Asia Pacific. So when people say Richemont has high exposure to China, it may even be higher than, you know, the 36% are from Asia Pacific because of this factor. Just something else to be mindful of. Sales by channel, about 55% of sales come from their own stores. They have about 1,900 owned boutiques around the world, and the rest are through wholesalers. So the main thing here is that, you know, they don't break out necessarily what's more profitable than the other, but with retail sales, they at least have full control of the pricing, where with wholesalers, they don't. And so what winds up happening is that if in soft times like now, is they wind up buying back product from wholesalers to prevent them from dumping product on the market at a discount. So with these luxury brands, of course, you don't ever want to sell anything at a discount if you can get away, you know, you get away with it. So I mentioned before, this is a very good business, and this is a 10-year snapshot. It looks a little fuzzy on my screen, but I'll tell you that the top one there is gross profit margin. It's north of 60% every year from 2005 to 2015. We have 2016 numbers was 64.3%, and the guidance is 65% going forward. So, you know, as we say, an excellent business in that respect. And ROICs average there about 23 for the 10-year period. 2016 is about 21%. Also, we have to talk about this guy. We are big fans of Rupert. He's chairman. He's the controlling shareholder. He's also quite a character. There's a book called Capital Returns, which maybe you've heard about. Capital Returns, very good book. There's a chapter here on him called The Wit and Wisdom of Johann Rupert that runs several pages. I would recommend that if you're interested in the name. So he's kind of a, you know, if you read through transcripts, he's a blunt talking, no nonsense kind of guy. He doesn't play, you know, Wall Street's games with guidance and all that. So I have a couple of quotes I pulled that I was going to read to you. One is he said, you can't discount us ever. You can discount us ever using equity for acquisitions. Equity is always the most expensive way to pay. So he says stuff like that. It's music to our ears. I mean, I think the one way to destroy value here is if they do an expensive acquisition, and we don't think Rupert will do that. He has a real appreciation for the price you pay for an asset determining your returns. And once there was an analyst who asked him on a call how he lost money on the sale of a business, and Rupert was quick to correct him. So here's his quote again. He said, "No, no, no, no. I didn't lose money when I tried to sell the business. I lost money when I bought the bloody thing. That's when you park your money. It's not when you try to find a bigger idiot than you to take it off your hands." Another quote we like is when he talks about the luxury business himself. He has some good lines about the timelessness of it. And he says, anniversaries, birthdays, and girlfriends are always going to be there. And he once compared luxury to tech, saying that if your intellectual property is in ones and zeros, you're going to have issues. So luckily, our intellectual property resides in atoms, and it's tough to wreck. That reminds me, one of the other potential risks here that we can talk about is the rise of smartwatches, and what's the effect of that on their watch business. And it's hard to say. At the margin, perhaps there's some change, but on the other hand, maybe people who are buying these Cartier watches are I don't know if they'll not own them and suddenly go to smartwatches, but it's something it's a potential risk we can talk about. But in short, we think that Richemont is in good hands as long as Rupert is at the helm. So now I'm going to hand it off for Thompson. He's going to go through, Thompson is a senior analyst at the family office, works with me there, and he's going to go through a little bit about why the stock's been cut in half and how we think about the valuation. And I'll just preface what he says by saying that when it comes to valuation, we try to be broadly right on these things. We don't, we use a variety of methods to try to get there, and we're not the type of investors that are going to give you this like super detailed spreadsheet and forecast out, what 2018 earnings are going to look like. We really do try to think long term and try to conceptually get things right. So as a result, just say that, when you look at our portfolio, we often find ourselves buying things that have these sort of, tough near-term outlooks, but we really rely on the quality of the business and the quality of the management team and the quality of the balance sheet, as well as a good price to pull us through over the years and deliver an attractive return, hopefully without taking much risk in the way of an impairment. So with that, I'll hand it over to Thompson.
Great. Thanks, Chris. Do you mind just doing the slides?
Yep, no problem.
Okay, cool. Thanks. Great. So the first thing that I'll talk about with Richemont is a pretty interesting data set, which comes from the Swiss Watch Federation. And every month they actually put out sales data on, how the Swiss watch industry is doing. They break it out by price point and by where it's in geographic location. So we think it's interesting, but of course, as Chris said, 80% of Richemont's operating income is actually coming from jewelry. So it's not super valuable, but we think it is a decent signal of what's going on. So in the next slide, I tried to sort of highlight some data points. Let's see here. I got two screens going. So a lot of this data is condensed, and I've mined it and played around with it. But all the stuff that's circled in red are the things I wanted to obviously draw your attention to. So the first table here is the 5-year CAGR sales figures for all Swiss watches. They provide data starting, I believe, in 2000. So you can see here, basically from 2005 to 2010, Hong Kong and China went on a luxury Swiss watch binge, and then, of course, that followed with the CNBC 2013 headline over here about how the government cracked down on this gift giving, which is, I guess, a code word for bribes or whatever. But and so the downturn has been pretty severe. Has been very severe with the 5-year CAGR in Hong Kong at 0%. In other words, sales are flat over 5 years of Swiss watches in Hong Kong. And then the second table, before we go to the next slide, just kind of breaks out. I try to think conceptually again about if you sort of back out this graph, the gift giving stuff, what's sort of a normalized level for Swiss watch sales into China and Hong Kong? And maybe 2000 is a good place to start. Maybe 2005 is. But you can see where we are on a trailing 12-month basis with the mix between Hong Kong and China and the rest of the world at 80-20. So it's come back quite a bit. And Richemont has obviously been affected as well. So this is just more data mining essentially that I've done. The year-over-year figures in Hong Kong continue to be bad. I mean, you can see 20+% declines in 2015, and then also leading into 2016. We're not really trying to time this. We're not market timers, and we're not trying to call a bottom. But I guess one thing that is somewhat interesting is this the uptick in China. This most recent month, they reported August numbers up 29%. So I don't know, maybe that's a signal. I'm not sure. And then lastly, here's just sort of the peak to trough decline of Swiss watches into Hong Kong and into China. So the decline has been pretty severe. So as Chris mentioned, sort of our valuation is approximately, we try to be approximately right. And we've sort of broken out just some high-level multiples of how the market is currently capitalizing this business. I won't get into the details, but this is basically where it's trading right now. And then the second way to think about it is on more of a private market value. What would it cost to buy this whole thing? These luxury multiples are quite high. With one in particular, the Swatch acquisition of Harry Winston at over 20 times EBITDA, which I think is pretty interesting, considering that Harry Winston is kind of similar to Cartier. It's probably the most similar on here in terms of being a jewelry retailer. So the third, and I think the way we really like to focus on this business is to think of it just like to basically do a discounted cash flow. And when I first started valuing this business and thinking about it, I was spending a fair bit of time kind of on the next 5 years and then, what's the terminal value? But in effect, I don't think it's really, what happened when I used that method is the bulk of the valuation, which can be very common, was all baked into the terminal period. So instead of going, for an explicit forecast and then go into the terminal period, I'm just saying, look, let's look at today's numbers and assume we're in the terminal period. So here's sort of the basic formulas I've used to get there. And then on the next slide is a little more detail. So the numbers here, the net operating profit after tax for next year, it's conceivable that could be a trough number. Once again, we're not trying to time the market, but it has fallen quite a bit, and the guidance has been pretty dire for what the company says they think they'll earn next year. The sell side's baking in, equally dire numbers. Starting from that base in our sort of numerator to figure out our essentially our growing perpetuity, I'm building into what our estimate of free cash is, which is really being driven by both the return on invested capital and the growth rate. So those are really the things that I think matter. And before we get to the next slide, there's a Charlie Munger quote that everyone's probably seen, but I think is super applicable here. But before we get to that, just sanity checking my estimates and my numbers. Chris showed you earlier the past 10 years, he showed you the return on invested capital has been very high, 20% plus. And then Richemont specifically's sales CAGR, not confusing it with the Swiss watch data, but Richemont's sales CAGR has been 10%. So I call it 5%. Obviously, your 100 basis points really affects this kind of valuation methodology, but that's sort of how we're thinking about it.
I would add in that the high return on invested capital of this business really drives the valuation. You're basically talking about a company that earns 20% return on invested capital in the world of 2% interest rates. It's going to be worth a lot of money. And so on this model, we're using what we think are conservative numbers, but it gets you 8% return, on this, it would be fine with us, but we've got a lot of upside optionality, which I think he'll talk about a little bit.
Yeah, perfect. Yeah, so we can kind of pop over here, which is like I was saying, the Charlie Munger quote. Even if you essentially he's saying, even if you overpay for a great business, look out 20 to 30 years, you're going to be fine. And we think with Richemont, as we saw earlier with the age of these brands, all the royal families have worn Cartier products, and Napoleon Bonaparte wore a Vacheron watch. I mean, these things have been around for so long that we think looking out 100 years is conceivable, and it seems reasonable too. So. And then the last thing is just basically, a Porter's almost five forces analysis, or just thinking, why does this company have high returns on invested capital? I think the reasons are pretty obvious, but you can see them here. And then the last thing that we didn't get into so much with the company are some of the free options. And aside from the net cash on the balance sheet, which I think is, what is it? I think it's over 5 billion, I think. Anyway, Richemont also owns half of a company, a publicly traded company called Yoox Net-a-Porter, or Net-a-Porter, which is kind of the Amazon of luxury clothes and jewelry and shoes. It's an interesting business. I think it's trading at about a 3 billion euro market cap in Italy. Has a very interesting CEO. Is it going to really move the needle? I don't know, but at least shows that Richemont does think about these things, and they incubated essentially one of these companies, and then merged them last year. So that's pretty much how we're thinking about it, and got an awesome panel here. So I'm sure we'll have lots of good questions and good discussion on Richemont.
All right, thank you, and thank you, Thompson. Thank you all. I'm really interested to hear different people's perspectives on Richemont.
Great, Chris, Thompson, thank you so much. That was a wonderful presentation on Richemont. I appreciate it. This was awesome.
Yes.
And everyone on the webcast, if you can, we'll have the Q&A amongst the panelists, but you can submit your questions on the Q&A dialog box, and I'll be sure to, Steve, I, or Andrew will be sure that it gets answered amongst the discussion here. So please, everybody on the webcast, please feel free to send your questions. So I'll start with the first question, which is, how do we think about the downside protection? I know you talked about brands which don't die for 100 years. And my question was, how do brands die, like luxury brands? I think I've heard of Parker pens, and some brands die. So basically, how can this die? That's a question.
Yeah, well, I think one way that luxury brands die is from an overexposure, or they start discounting and then they can't recover from that. So you're really relying on, I think this is one case where a controlling shareholder is a bonus, because Rupert isn't going to feel the pressure that maybe, if he was just a regular CEO and he's going to have people on his butt, trying to meet earnings numbers, or pressure to make an acquisition, or pressure to do buybacks, or pressure to do something. I think he's been through these cycles before, and he understands the luxury business. He understands that to preserve those brands is the lifeblood of the company. So your downside protection is in that. And in some ways, I've thought a lot about brand investing, because my personal background is much more in the hard stuff. Like, I used to really love investing in real estate and things that have, plants and equipment and things you can look at and say they cost to build. And brands, it gets a little squishy, but in a way, a brand is just like a physical asset. It's just like a building. If you don't maintain it, you don't care for it, you don't run it right, it's not going to keep its value. And so you have to watch and make sure they do that. And one of the steps they've done is they bought back a bunch of stuff from wholesalers to keep their stuff off the streets, keep their prices up. It's bad when they have to do that, but it's part of the playbook of a luxury brand. And your downside, I think, is really then in that those high gross profit margins and those high ROICs. And if this business can continue to do that, even if revenues are relatively soft or don't go anywhere or flat, you're going to do pretty well. I mean, we've run different scenarios where we kept revenues pretty flat, and you're still going to get the dividend plus the with that return on invested capital over time. It's going to still be, it ought to still be a high single digit number, I think. But that's the way we think about it.
So Chris and Thompson, just on this, when we looked at Ferrari and all the other luxury brands, a fair amount of them actually never had sales contractions in 08, 09, and Richemont did. Have you, like, have you kind of studied that demand function? Why did they actually have contraction, in 08, 09?
Well, Thompson, you can correct me here, but I believe in 08, the business itself actually did okay. And I think it was China that bailed them out then. And then now they don't have China. So anyone else?
If you back out China, it was
correct.
I remember it was not great.
If you backed out China, it wasn't so good.
But if you backed out China from LVMH, Hermes, everyone else, it was still okay. Like demand never really went down that badly. But you know what? That's probably going into a totally different theme of.
Well, if I may say, the business has changed enormously in the last 10 or 12 years. I personally own shares of the company maybe a decade now. And the company has become much more capital intensive and has much more operating leverage as it has de-emphasized the franchise distribution model. And you can really see this if you look at the CapEx of the business since 2011. And if you break out where the capital has been spent, how much of it was spent on manufacturing, how much of it was spent on retail, and then take a look at the corresponding rent as a percentage of sales that has changed since this rapid movement to protect the business from what they learned in the 08, 09 discounting environment. What you've seen is Mr. Rupert has changed this business significantly, where it may not produce the returns on capital in slow periods that it used to produce, but he has a greater probability of protecting the business from deep discounting from his partners, where he now has partnership as opposed to traditional partners. If you look at how much of what has happened to rent expense as a percentage of sales, if you go back to 2011, before they really started bringing or verticalizing the business and taking over more of the larger selling per square foot stores, rent was running a little over 6.5% of total sales in 2011. And keep in mind, total sales were $6.8 billion. And at the end of 16, sales were $11 billion, and rents as a percentage of sales had risen just shy of 9% of sales. So they're up from 6 to 9. So you've got this increased operating leverage in the business. In addition to that, you have increased CapEx. Total CapEx in 2011 was $285 million, of which only about half of that went to retail. Well, in 2012, you had this enormous jump in CapEx, which was about 50% from where it was in 2011. And last year, CapEx was $710 million, of which half was dedicated to retail. So you've seen this verticalization of the business that it was not verticalized prior to that downturn, Stephen, that you're referencing. And I think the reason that occurred was Mr. Rupert figuring out that if he did not have control over the pricing of his products, the gray market could destroy his business.
Daniel, I just want to bring Daniel into it again because I know that he, as a consumer and user of some of these, probably knows a lot about it. And you might share a little bit, some of your personal knowledge and experience of how these businesses work. And I mean, you had some interesting things you told me about the kind of people buy. It's not necessarily they're all billionaires or whatever who are buying or collecting these watches. So,
well, it's an interesting group. It's an interesting group of odd people, of which I'm one of them. And to your comment earlier about the smartwatch as a risk, all these Swiss manufacturers, primarily of watches, is what we're all worried about, because watches are where the problems have recently arisen. However, I would argue if you read consensus sell-side research today, consensus sell-side research is worried about exactly what we're talking about. So it's not a surprise anymore. Over the last 4 or 5 years, every research report on the sell side you read was strong buy, strong buy, strong buy. There was one guy out there that had a negative report in December and he was right. And he was talking about the inventory problems. He was talking about the decline in sales. He was talking about the contribution of watches inside Cartier. And when you look at the average selling price of a Cartier, I have pulled information from German sources that's a year and a half old that is telling me that Cartier is making 450,000 units a year and the average selling price is about $5,000. So when you look at the hierarchy of watches, at the ultra high end, hand finished, hand built, hand assembled, these are true artisanal products. Well, as you move down the chain to less expensive, more available watches, you start to see these consumer franchises that emerge. Rolex emerges, making 700,000 watches a year, yet maintaining its pricing power and exclusivity to its dealership network. They're not at risk of the smartwatch. The guys out here in the world that are at risk of the smartwatch are the people that sell products at low average selling prices, and they're not really collectible. You may be surprised. I was shocked to find out that Baume & Mercier, and I can't substantiate this because they're so secretive about giving you numbers, but there are various other organizations that I belong to where we all talk about this with other watch insiders. And in 2014, Baume & Mercier was making 100,000 watches with an average selling price of about $1,200. That segment of the business doesn't have the same quality of durability, in my opinion, as what you would find at Vacheron or what you would find at Piaget or what you would find emerging at Panerai on the watch side of the business. So there is still this hierarchy here at Richemont of various grades of consumer modes. And I would argue there's probably various levels of pricing power. Vacheron makes between 40 and 60,000 watches a year. They make fewer watches than Patek Philippe. And you can see their distribution network in the last 7 years has doubled from 22 outlets to about 55 outlets, of which 75% of those outlets are internal, meaning they're owned and operated by the firm. That's the other thing here that has changed enormously over time. It's when you look at the business in 2015 in China, in the mainland, Cartier, to the point of how do you destroy luxury brands, Cartier internalized all 15 boutiques except one in an attempt to protect the boutiques from discounting and inventory control. Nike did it. Brown-Forman has done it. All these companies with really long-term thinkers at the helm have had to do this with distribution in China to keep control of the price. But when you really look at this business, it is a collection of novel companies. The stroke of genius that I enjoyed out of Mr. Rupert was this unwillingness to vertically integrate the manufacturing of each product, where he could have had the 400,000 Cartier pieces manufactured anywhere and just slapped a Cartier name on it. He did not let the manufacturing of the Maisons cross-pollinate, which I thought was genius, because authenticity is the source of the consumer pricing power, and never supplying demand, keeping the product in chronic shortage, is how you ensure that the consumer is left always wanting more. And having studied lots of luxury goods businesses over time, this one jumps off the page at you because of all the behaviors in the downturn in 9 and 10, where they cut production, they cut overtime, they integrated distribution models. They did everything that all of us on the call would do if we owned 100% of the company and did not care about quarterly results. They're doing it again right now. You can see it in how they're managing the company, deepening distribution, taking doors away from wholesale, and verticalizing the company. They are doing everything they can, even at the expense of increasing operating leverage and making the business operationally more volatile to control the business. And this is exactly why, in my mind, this large cash hoard that is sitting on the side deserves to be there. Because if you hit a prolonged downturn where wealth doesn't grow around the world, demand for these products will erode. And when you put yourself in the shoes of manufacturer, lessor of buildings, you've just twisted your leverage up greatly. I was looking at operating lease expense in 2016. It's almost $1 billion. If you go back to 2011, operating leases all in were less than $500 million. So they're spending twice as much on operating leases in these upgraded stores, shifting to VC&A, shifting to Van Cleef & Arpels, shifting to Cartier, shifting to the specialist watchmakers. And one of the things that I find interesting is about 50% of the owned internally leased stores are in the other category. You know, this other category that gets very little thought or attention by most of the sell side is kind of interesting, because there is operating profit in that other category that's used to subsidize case manufacturing, component manufacturing, spring manufacturing, the actual guts that go into a watch. They're very expensive. And now that all of the ability to supply has been wrung out of the marketplace, that section of the business deserves, you know, considerable amount of thought. In addition, the real estate in those internal boutiques, when you go look at where Chloe and Lancel and Purdy are located, the overhead associated with these spaces that are premier retail spaces in the world, for that division to operate at a break even or a rough break even means those units, Montblanc, subsidized watchmaking. So it's important to, I have spent tons of time there talking to everybody I know, and it's become real clear to me that I don't know very much about it, nor does hardly anybody else. It gets no time and attention. So I have been fascinated by those businesses, and also fascinated by the operating leverage that they produce in the company. That I think over time, if you want to improve the operations or things got really difficult, the way you do it is cutting back on those internalized boutiques where the returns on capital are much below the traditional watch and jewelry business. Chris, I don't know if I answered the question. I'm rambling. I'm sorry.
No, that's good. That's what I wanted you to hear. I wanted to hear, yeah.
Well, Daniel, I'm a little disappointed you're wearing a polo and not a Peter Millar polo, which is one of the recent acquisitions.
I'm sorry.
That's all right. I forgive you. Can you explain why they do the buybacks? Sorry, not of stock, of actual inventory. Maybe a little bit better than there was a question on why Richemont versus Louis, which is an interesting discussion, I think.
Well, I think part of the reason on the difficulty on share repurchase is the dual structure of shares. And Mr. Rupert, if I remember correctly, and don't hold me to this, I could be wrong, there are some special laws in Switzerland when you're a controlled company on your ability to buy back shares. And I think the holding company that owns Mr. Rupert's shares, the LLC, where he's the managing member, but also has two other members in the partnership that happen to be on Richemont's board proper. I believe that's the limiting factor, is that they are held back on their share repurchase outside of dilution from issued shares by regulation. And I think it's due to this control position in these shares that are super voting and have majority control. That's my understanding. I've never gotten a really good answer on that.
Well, I'd also add that in his transcripts, he addresses the buyback question sometimes, and he usually says something along the lines. He's usually critical of it. He'll say people buy back their stock, at the top. So here's a quote I just pulled from what he said in May of 2015. He says, "Do you know the pressure we've had? Share buybacks, share buybacks, share buybacks. When you buy back shares, when you've got cash." When you have cash at the height of a cycle. So, then the cycle turns, your share falls out of bed, and you ain't got no cash left. That's what he said. So, I mean, I think he understands, I think he understands the buybacks and why you do it, but I think he's also, very, very careful that,
I would also argue he would rather own operating assets than a greater percentage of the company without controlling the entire company. If you saw a very large share repurchase at Richemont, my expectation, if I handicap that, would be that it would be to go private, as opposed to just taking back 5, 6, 7% of the stock. Because under the environment where Richemont blows up, other luxury goods companies or privately held luxury goods companies would be suffering as well. And another important component here to Richemont is scale that Richemont has from its shared services division on leasing and procuring in the supply chain. These are a big deal in the company. And my thought, to which I would agree, is a wonderful usage of capital, would be when you do find branded luxury companies, branded jewelry in particular, which is a very small portion of the jewelry market as a whole, something like maybe 20% of all jewelry, high jewelry is branded jewelry. I would much rather have earning assets that can be operated and put into the system of Richemont than buy back the shares, unless the shares were just unbelievably expensive.
And they've done
Because
that.
the change in operating earnings is equally valuable to us long-term shareholders.
And they've done that before with Van Cleef and Arpels, right? I mean, that was a.
They did. They owned they owned half of it, then they consolidated the rest. And when you look at what they've done with Van Cleef since 2011 and further back, I remember owning Richemont shares when every call was a complaint about Van Cleef, and now it's the second largest contributor to operating profit in the firm. And Van Cleef, I think, is pretty instructional too. If you look at where they're spending their money, 2012 retail was $200 million. Most of it was spent on new boutiques at Van Cleef and Cartier. 2013, they spent $250 million capex on retail, major renovations at Cartier. They opened 5 new Van Cleef and Arpels boutiques. And if you look at the internal boutiques, the total number of VC&A boutiques in 2001 was 84 in the world, total units available. Today, there are 105 boutiques available, of which 73 of those are owned by the company. So, you know, they've gone from owning 50 to owning 73 in 5 years. And when you walk into these boutiques and you look at how expensive the upfit is and how it probably is a depreciable item over 7 to 10 years, the business is becoming more capital intensive rather than less, because the maintenance cap spending that you have to have here to keep these things fresh and looking good and making me feel special when I walk in is higher than it used to be. And it's much higher in the company-owned stores as opposed to a partner store where they have a display as opposed to the entire store.
On a related subject of repurchases, I think one of the things that's interesting is the degree to which these guys manage inventory exceedingly well back in the 08-09 crisis, slowing manufacturing, taking inventory away from Cartier. A little bit different today and perhaps more aggressive with the downturn in Chinese demand, on the backs of the level of Chinese tourism within their store network, particularly in the third-party network, physically removing inventory from the channel and scrapping it, which is something they really didn't do in earnest in 08. You guys want to add some color on that?
Well, there are some different schools of thought on that. One school believes that the inventory that was stuck in the channel at Cartier was, in 2011, Cartier moved full steam into high watchmaking, which it had historically been a women's watch company and some men's watches, but it was not what you would consider a high watchmaking company. They recruited a lady who was a head watchmaker from AP, from Audemars Piguet. She ended up manufacturing Geneva sealed movements with some Roger Dubuis fellows that had been there. They acquired the rest of Roger Dubuis recently. And the belief out in the sell side community is that the inventory that was stuck and was unable to be moved was the high watchmaking watches that were in the channel that have had a hard time getting traction. And these were the high complicated Rotons, the Astro Tourbillons, the watches that you'd seen rolled out at SIHH over the last 7 or 8 years ranged anywhere at the beginning price for gold between $25,000 and $250,000. And, to pull back $250 million of inventory of $20,000 to $50,000 watches, it's not a lot of pieces, but it is pieces where, you want to protect your pricing on those pieces as much as you can because they're your showcase pieces. You don't manufacture, 100,000 of those. You manufacture 5,000 to 6,000 in any given year, and you use them as a showcase. So I'm not sure what happened there, but my guess from the dealers I talked to, they had the same experience where they were having trouble moving the high complication pieces. They were not having trouble moving the stainless pieces or the tanks or the Santos, the more traditional watches in the men's line that you have seen sold. So when you're looking at $250 million out of, the belief is that Cartier watch sales, and they hide this information. They never give it to us. When we ask directly, they dodge and laugh at us and tell us no, frankly. But Cartier watch sales are thought to be somewhere in the 40% of revenue, $1.4 billion, something like that at Cartier. So when you think about $250 million being brought back, and inventory typically sits for, when you've got 20 months of turn, this stuff might be 2 or 3 years old. So it was great in my mind to see them destroy it and publicly destroy it, because it sends a message to the rest of the partners that they better behave like partners or they'll be shut off.
Yeah, they actually disclosed in the annual this year that watch sales in the aggregate actually make up about 46% of sales.
They've been giving that information out for a long time. You just have to dig through the notes for it.
Yeah.
It's been as high as 50.
Yeah, so the jewelry segment of their $6 billion in sales, only just under $4 billion is actually in the jewelry side. The remainder of that would be their watch business. So you get a little bit
jewelry
more cash flow from watches than goes reported.
Yeah, jewelry was somewhere in the mid 3.5, and you also have a hard time. They mail me cologne, they mail me clothing, they mail me all kinds of stuff as a Cartier buyer. So it's really hard to tease apart exactly what it is, and they guard it well. But I think it's safe to assume when you're manufacturing that many pieces, you probably have manufacturing economics at Cartier watches, as opposed to high watch making piece by piece, where it takes 3 years to make something, and that's why it costs $50,000 or $60,000. And you're right, jewelry is important. Watches are important, but this is a watch and jewelry business where roughly half of the revenue has been watches, and I think that's why the sell side's been so spooked by the watch turndown.
Mm-hmm.
I have long thought that pricing power would save them here. And the question in my mind really is this a secular or cyclical trend down? From what I can see and observe in the purchasing habits of watch buyers, once you're in the club, you're forever changed. You're forever a weirdo. You can't ever go back. And
so is there real pricing power? Sorry, is there real pricing power, Daniel?
Yeah, if you look historically at unit volume growth and pricing power at Van Cleef and at JLC and at Piaget for sure, when you go through the tiers of high from high watchmaking where you're selling very few units that are truly artisanal units, like I would argue Vacheron is the very top here. As you go from Vacheron through Piaget all the way down the chain to where you get to the manufacturing economics, there probably are not our pricing powers when you get down into the Baume and Mercier units. And I would argue that's probably why you saw them partner with Chow Tai Fook earlier to get distribution in those stores. When you're looking for distribution, you typically need distribution. I'm not sure that Vacheron needs distribution help. They only sell 50,000 units. I was doing some math, and it's like 2 watches a day per boutique. I mean, that shouldn't be impossible to do. So I think there's pricing power on high jewelry. I think there's pricing power in intermediate jewelry. In traditional jewelry that's under $1,500, there's probably not pricing power. But if you start looking at Lange, where they were making 5,000 watches just a few years ago, and they just finished expanding capacity. If you look where the capacity expansions are, it's in all the businesses with pricing power. It's in high jewelry. It's in the workshops for high jewelry. It's in Vacheron. It's in JLC. It's in Lange. It's in Panerai. It's in IWC. It's in Piaget. It's in Roger Dubuis. These are all the specialist watchmakers that really are not producing many units, and they really do have pricing power.
I'll just add one other thing when we were talking about the inventory buybacks. It might be worth mentioning that on their last call, they said those buybacks were largely over. So maybe it's an indication that some sort of bottom is in. But also,
it's not the first time. They bought back their Abu Dhabi distributor in the financial crisis, where they were selling. You've noticed they've built all this internal store expansion in Abu Dhabi. Historically, they just had distribution through their franchise partners. Well, they had to buy their franchise partner back because of this issue of price. And I think that's the subtle thing that happened here coming out of Stephen's question about the financial crisis. It's a very good question. I think management learned that the next downturn, if they're heavily relying on franchise partners, they could destroy their business.
yeah, I think that's a good question.
Just an observation. It's so funny. The Europeans are made fun of because they don't have tech businesses or new economy businesses. But I think from a management perspective, the European family-controlled businesses are much better able to have the position that they have, which is just we protect the quality of the brand and make sure that, Ferrari always says we're going to make sure that we sell at least, one less car than actual demand. But it sounds like not all of their businesses, they're actually underproducing relative to demand, but they're, in terms of capital allocation since 08, your hypothesis is that basically everything has gone towards businesses where they're underproducing relative to demand, and therefore you have a recession-resistant, basically level of demand, right?
For me, I don't know that I would say they're necessarily recession resistant. I mean, I can imagine scenarios where things could get pretty nasty, but I guess the way I would think of it more in terms of the risk of some sort of permanent impairment in this business is low. I mean, I think even with the increased operating margin in the business, with those balance sheets and with that gross margin, I mean, they ought to be able to survive it. But I don't know. I mean, it's a good question. I don't really know. Maybe someone in the panel has a better idea about the ability of Richemont to withstand recession.
Well, I think if you look at the operations, their response to recessions has been appropriate, with squeezing fast, and every bad downturn has been met as though it's a secular downturn, not a cyclical downturn, in how they behave. This particular downturn in watches is special because of the depth. When you look at the Swiss Watch Federation data, this downturn is surprising. And when you correlate that probably 40% of the watch buyers across the industry emanate on a plane out of Asia somewhere, you have this special one-off opportunity where if you do really get a meltdown in the mainland and 40% of the buyers really are hopping on a plane and they're not going to Macau now because of currency shifts, they're going to the UK. I would be shocked if in the next earnings release we don't find out that UK was in sellout and they were having to move product there because of the movement of the pound. The buyer is incredibly intelligent and engaged. I would not argue that it's a recession-resistant business. I would argue that it is a very durable business if held in the hands of an owner-operator with the appropriate mindset. I can show you other luxury goods companies that the unit economics are not this good, but that have seen their businesses destroyed by improperly incentivized management teams.
Yeah. So I'm just gonna with this discussion, I wanted to kind of touch on one of the first questions here on the webcast is so basically LVMH's weakest segment is actually jewelry and watches, which is no new trend, but it looks like Richemont's actually no longer cheap on a relative value basis. Would you agree with this?
Well, I mean, I think if you look at, current multiples, they don't look cheap in absolute terms. It's not like it's trading for 10 times earnings.
But then, see, the thing is that I think for especially special sits guys, we look at EBITDA. The EBITDA valuations here are so high, but that's because I guess as Daniel's point, the capital intensity has gone up, but that doesn't mean that generally the earnings multiples are very high. If Hermes has no DNA, right? So the EBITDA multiple is almost the same as the earnings multiple. But I'm guessing so they've already been cycling through. They're down. The Chinese corruption trade has been in effect for 18 months, right? So you've almost fully anniversaried the entire crackdown on people having watches like underneath their jackets when they go through customs, right?
That's right.
It's been going on since 2013. It's been going on much longer than that. Yes.
Yeah.
And it has gained steam. It has not lost steam.
Okay.
And you really can see it at Vacheron, because Vacheron was disproportionately represented to the Asian buyer.
Okay.
And
I'm not sure
I would just sorry, with LVMH, the difference in multiples could be because of the difference in returns on invested capital. I think it's lower at LVMH, so that'd be,
it's much lower.
yeah, 10% maybe.
That's because they're buying. That's because they're buying things at 15 times EBITDA to plug them in their distribution chain. But Richemont's not in that same game.
Sure.
No, and this question of Richemont's relative valuation to Louis Vuitton, you're exactly right. They're different animals. They're both practically controlled companies. Mr. Arnault, I don't know off the top of my head if he has control or not, but I know he owns a third of the shares. But they're similar businesses in the luxury space. But when you look at Louis Vuitton's exposure to leather as a percentage, leather and beverage, alcohol, as a percentage of total operating income, it's very large. And you have all this other capital invested in the company, primarily in fashion and jewelry and direct retailing, that does not earn a really high return on capital. And I would argue it doesn't deserve as high a multiple for that reason, to Thompson's point.
And by the way, the LVMH or the Louis Vuitton leather is not actually leather, but
Yeah. Well, this is one of the things that's remarkable to me about Richemont is even, we're more than 2 years now into this slog, 3 years or whatever it is, but still produces a lot of cash, and the gross profit margin is still way up there. Return on invested capital is still way up there. Normally you have a company to go through that kind of cyclical downturn, you're going to see at least some deterioration in those kinds of things. And I think it speaks to the quality of the business. It's just a really, really high quality business, and you have to tell it differently.
How many manufacturers can you name that are manufacturers that have 65% gross margins? I can't name another one other than maybe Patek Philippe if they showed us the numbers.
Ferrari.
But when you think about the economics of Ferrari, yeah. When you think about the economics of manufacturing, the nature of manufacturing is not high gross margin. That's the nature of software and service. So it's an interesting business.
Okay, let's go. I wanted to, we're talking about, just before we even totally get off the China hard landing and the corruption, good question. Actually, just a good rhetorical question almost. Like, if you think about a hard landing in China, can you own the name? And I want to take a stab at this because I kind of have a view, which is, I think the hard landing, and correct me if you guys believe differently, I think the hard landing in China for luxury products is so long in the tooth at this point. There's no new, this is a very old thing that's been happening for multiple years. Because of the corruption crackdown. And so I think, therefore, like, if you have an industrial slowdown in China, I'm not even sure these cycles are totally connected at this point. But let's go back to that. Do you guys, so Daniel, you mentioned that the corruption crackdown is actually accelerating. So this is one thing that, Chris, when we were talking about this in Italy, when you guys were, when you were talking about how you got comfortable with that, basically trend sales in China had returned back to pre-binge levels. But I'm almost worried that there's a, in auto sales, like you'll have that give back effect where you'll have like this period of basically stimulated demand that's above trend, and then you give all of that back through the downturn. So then the downturn is actually way worse than sort of trend demand. Do y'all have any refined thoughts on that?
Well, I think part of that is the degree to which you've seen an increase in business internally in China, completely offset by the lack of Chinese tourism and traveling abroad. You've seen a slowdown in the number of visas that are granted. The company doesn't disclose the origin of its customer in its store base globally. But they sure do point to the fact that they're seeing fewer Chinese purchases made in the stores. So I don't know, is that a wash? I don't know. I think along those same lines, it's interesting. Mr. Rupert's famous for quoting Coco Chanel, saying money is money is money. Only the pockets change. When they bought LMH back in '99 or 2000, it was three companies: IWC, Jaeger, and Lang & Son. They had sales distribution really only in 3 countries in Europe, and they chased the money, and they saw the oncoming onslaught of Chinese demand and expanded the brand substantially globally, and largely did that in the wholesale channel. And to Daniel's point, you've got this retrenchment where the company's internalizing, spending CapEx internally on their own retail channel. And I think the $1 million question for us is, to what end has brand expansion already run its course? They point to continued strong demand in India, in the Middle East, and places like that. But how much of the appeal of this new wealth and the introduction of these products in places like China has already run its course is evidenced by the reversal flows of building out the retail stores at the expense of the wholesale channel. It's a completely different business, and business was half the size not that many years ago. So to the valuation question, how much core organic growth is there with this thing prospectively, given that it's a different animal than it was when they largely just distributed in the industrialized world, for lack of a better term.
So I want to take a stab at that. I think personally, you have, in the bifurcation of wealth in the world, people with no family traditions or family history, especially outside of Europe, have to basically buy their status. And Chris asked a very rhetorical question in Italy a couple months ago, like, what business will be here in 100 years? And when we looked at Harry Winston, the spinoff, one thing that was really interesting is that actual rocks and metals don't really hold their value inflation adjusted over time or they don't appreciate, they just hold their value. Whereas art jewelry like Van Cleef actually appreciates similarly to Ferraris and Picassos and artwork, right? So I think honestly the long term here is actually easier. One thing that we've been trying to do is look for shorts in the luxury space, where like trends masquerading as luxury companies. Like think of Tod's, I think Burberry could be that. But I don't see any trends besides maybe the Vacheron watch buying from Chinese. I don't see any sort of like widespread fads in their portfolio. I could be wrong. And if you agree with that, then you're basically going to compound at least in line with the upper class, which has been compounding at rates very, very much higher than the rate of population growth. Do y'all disagree?
No, I think you're totally right. What
Yeah.
you have to do on this thing is you have to make a function. You have to assume a function for wealth growth around the world. And then you have to assume what percentage of these newly minted high net worth people, to your point, want status, And that becomes your incremental buyer over time for both watches and jewelry. And you have to just make an estimate of the rate of growth. And I think that's how Bain has done it in all the stuff they've published. And I think there's another Knight and someone, I can't recall I don't want to take credit for the idea, it's not my own, that they have published hard numbers looking backwards at the rate of change of millionaires in various countries in the world, and used it as an explanatory variable for jewelry and high watch demand. And the R-square on it is really high. So that's the ultimate driver here, is the change in wealth in the world. And you really have to make it a demography question, more so than, thinking about it as a retailer with same-store sales and, who's buying 2 watches or 3 watches. It's really driven by wealth. You're exactly right.
Yeah, I agree 100% with your point. And also, when you talked about their products appreciating, I mean, that's an interesting point. Not all of them do, and Daniel will know this much better than I did, but we did do a little research on that, and there's Just Collecting Rare Watch Index, which has shown about 5.5% increase from over the last 10 years. And if you look at the best performing watches, there are some Richemont brands in there, but it's a mix. But anyway, that's an interesting point. I mean, a lot of this stuff, especially the higher end stuff, is stuff that's going to be around a long time and hold its value at least.
Yeah, if you look at all the auctions out there for high jewelry, I read a quote from the old CEO of Cartier, who was the CEO in 2009 or something. I can't remember. Platt was his name. There were 25 straight years of auction data where they had not had a piece of jewelry sell for less than what it was originally sold for, which also reinforces this idea that pricing power has been there a long time. And on the watch side of the world, if you remove Rolex and Patek from the watch appreciation index, the index falls apart because most of the appreciation is accountable in those 2 brands, or truly high one-off kind of non-industrialized watches, where you're looking at the true watch that was ordered and took 5 years to make, or 2 years, or 3 years. There is a collector's market, but there's also a business here, and I think Ferrari may look like this too.
That's what's so attractive to me from a Ferrari perspective is, and I agree, if we could buy Patek, we would want to do it, but it's like you almost guarantee the demand, because the collectors feel so much more comfortable with the fact that they're not buying depreciating assets. If you can actually secure that, I mean, it's a very interesting dynamic to study with underproducing. Like, you have to produce how we measure it with Ferrari. You won't be able to get the data from Rupert, but we just basically monitor the waiting list for the cars, and so as long as the waiting lists are at least 12 months long, we're good. Like, the products will keep appreciating. But if it starts to get substantially below that, so like even Teslas would go up in value when the waiting lists were that long, and now they're depreciating. So it's a function of how long does it take for you to actually fulfill your order. Hermes the same with the Birkin bag. So if there's a way to measure that, that would be incredibly useful, but that's all hypothetical at this point. Okay, let's see. Does anyone want to ask some questions live? Because I'm going to start asking some questions from the webcast.
Steve, I had just a follow-up on that, which is, who are the real, because we talked about a little bit about Louis Vuitton, and we talked about Burberry, that they are not real competitors. They are in the clothes and leather and all those businesses which are depreciating assets. But at least here, we don't know what percent, but there is significant percent of Richemont products which are appreciating assets or prices, which is fantastic. So my question is, are there any other public companies? I mean, we mentioned in the jewelry and watch segment, which have these sort of, let's call it, ultra high-end appreciating assets like Ferrari in the car world, or Richemont is the only standalone company? And the second part was, I know Dave Marcus was here in this forum a couple of months back, and I know he loves the CEO of Louis Vuitton, which is with Bernard Arnault. I was just wondering, the second question was management. If you look at the managers in this business, luxury or ultra luxury, who are the top end of the management team? Is Rupert there, or are there people who are better than him? Because it seems to me, when I asked the question earlier about downside protection, it seems like management plays a big role. Everyone talked about at length about how they handle the crisis and how did they manage the inventory, verticalization. So a lot of things, a lot of management effort needs to go in for the brands to maintain value, which Chris said, giving an analogy with the PP&E. So two parts. One is, if there is a public company or even a private company equivalent, and second, who are the best managers in this business?
That's a good question.
Maybe Swatch? I don't know. It'd be obvious.
No, Terry Stern is the best manager in the business. He's the family that controls Patek Philippe. They have put their money where their mouth is at auctions, and they have supported the auction prices of watches that are not novel, and created this comfort in the buyer of a Patek, knowing that they can at least get their money out the next day. And they've also created this expectation that if they buy it today, they should be able to sell it for more tomorrow. It's very interesting behavior. I would say that they have done the best job in my mind, closely followed by the folks at Cartier, and improving performance at Cartier for destroying inventory, for shutting down distribution, for bringing things in-house, and for decreasing the chances of harming the brand.
Who was it?
I remember when VCNA was not very valuable. I remember when everybody hated Van Cleef, and now everybody loves Van Cleef.
Who was that? Terry, the first one you mentioned, Daniel?
Stern. Terry Stern. The Stern family controls Patek. Audemars Piguet would be another company I would reference, which AP is family controlled as well. And they've had some management turnover recently. But, both these companies make 50, 60,000 watches a year. And when you're looking for appreciating assets, you normally find it in high jewelry more so than in watches.
Wait, Daniel, that's always been a hypothetical that we've compared with Ferrari to Patek. I didn't realize it was 50, 60,000 watches a year. Is that like, I thought a lot of their business was driven by, they have like 200 different SKUs that you won't even know about, but if you're in the club, then you may get the sneak peek at the $1 million, whatever, $500,000 watch that they're going to make two of, and it's going to have X, et cetera, et cetera, et cetera. I thought that was a huge portion of Patek's business, no?
It is, but it's led by the Calatrava line, where the Calatrava is accessible. And as you move up the pyramid with Patek, they basically interview you and to put you in this club to make sure that when they do create one of these one-off complications, that they have a ready list of buyers for that product.
Yeah.
Well, it's very ingenious with what they've done.
I love how you just characterize a $20,000 watch as accessible.
Well, if you're a hardcore watch weirdo, that's the entry level for Vacheron. It's the entry, and this is in gold. It's the entry level for Breguet, which is a Swatch company. It's the entry level for most of the hand polished, hand finished gold watches. And in the case of Patek, they've even gone as far, or Ferrari's gone as far as Patek, I'm not sure which one, in giving you preferred access if you already own one or more of the product. I've got clients that own multiple Ferraris, so when a new one rolls out, they move up the list.
Van Cleef and Cartier are much more approachable. You don't actually have to be a diehard collector to get the interesting leopard, whatever, diamond, $500,000 necklace, right? Like that's kind of accessible to anyone who can pay for it at the Richemont brands, right?
It is. There are special rooms in the boutiques where you find yourself when they start pulling out the high jewelry products.
Right, but it's
But
not.
if
It's
you
not.
have been identified as
You're not
I'm
buying
sorry, go
into
ahead.
a cult as much, right?
No, that's exactly right, and that's the strange thing about branded jewelry, that the watch guys have been better at turning us all into participants at Jonestown, where we really buy into the cult. Whereas in jewelry, branded jewelry has not been that successful, primarily because we all know more about the things that go into making diamonds better. The artisanal component of Harry Winston and Piaget's diamonds is very valuable. And the same goes for Patek Philippe. But it's, in my mind, and these are all my opinions. I mean, I don't know any of this for fact, but in my mind, that's one of the reasons why everybody is chasing branded jewelry, is the ability or opportunity set to penetrate that market and turn it into something where somehow I view a perfect diamond from Cartier as somehow better than a perfect diamond from my local jeweler. Goodwill is what they're trying to build.
I've got a question on management. In 08, Mr. Rupert pointed out that some 8 years prior, the business was not vertically integrated, that each of the Maisons really didn't have definable, assignable assets, and that measuring returns on capital and performance at each of the watchmakers was a little nebulous. So a lot of that was done and carried at the holding company level, and going to a vertically integrated model and taking the manufacturing in-house and buying some of the component manufacturers, doing more of this internally. I think he alludes to that solving some of the succession issues. You know, he had 3 stints inserted in 2011. You know, the question of who replaces him, you know, if he sit by the proverbial bus is on the table. Do you guys think that vertical integration really has solved some of the problem, or is the bench a little weaker with some of the longstanding CEOs now gone from the company, or at least retired to the board and not so much involved in operations anymore?
Well, I think that's a really good question. I know that the succession question has come up before. We've gotten that question too. We don't have a good answer for that. Yeah, I mean, apparently, you know, he was, you know, he went on a 1-year sabbatical. What was that? A couple of years ago, and you know, the rumor is he wasn't necessarily in great health and a heavy smoker and all that. So that's an issue. It's something we haven't talked about. But you know, how much are we relying on Rupert, and what's the succession plan like? And you know, I don't know.
It sounds like to me, I mean, I know at Ferrari, it sounds like it's a cultural acknowledgement at the company that they need to protect the value of the pricing. They need to protect the channels. Everyone in luxury is talking about retail excellence, which is, you know, handwritten notes to all the customers, basically just develop it. That's a cultural thing, right? I mean, like, to me, luxury's gotten so much smarter over the last 15 years, particularly as actually China has evaporated from the luxury market.
Mm-hmm.
Do you agree?
I would agree. And another thing is, you know, Rupert is maybe not so much involved anymore. He's chairman now, and you know, he's got a CEO, and so perhaps that's right. You know, the cultural, I don't know what you call it. The culture within the company will be enough, and what you'll miss with Rupert will be the capital allocation and you know, the discipline they've made and things that they've done in the through the crisis. Well, let's see.
That brings me to another actual question. Can we talk about, is there, you know, actually one of the world's most famous shorters just told me on the phone yesterday how he hates the current shorting environment because of the takeout risk. And is that an issue? I mean, if he dies, is LVMH backstopping this thing?
Yeah, I mean, we've generally taken the view that Richemont is not for sale and wouldn't would be a hard takeout candidate. But with him out, again, that's hard to say. I don't know who the succession, what the succession plan is, and what their feelings are on taking Rishman out. But certainly, yeah, I mean, it would be, I think, an attractive candidate for somebody like LVMH for sure.
I don't know who else could buy it
Yeah.
at the market cap of Richemont. I'm not sure who else with honest synergies in distribution and sales and similarly overlap products could write a check. And I'm not sure the family would want a check. From a tax perspective, that would be very difficult. And when you look at the board is not young. Bernard Fornas just retired. He had been with Cartier for 20 some odd years. Richard is 64. Mr. Rupert, 66. Gary Assange is the young guy there at 56 in the executive suite. But when you look at the new CEO of Cartier, the CEO of Van Cleef & Arpels, CEO of IWC, they're young. They're all relatively young in those positions. I think Philippe at Piaget may be the oldest guy running a company now. Daniel Arito at JLC is not old. Jerome Lambert just left there. He was a fix-it man and ended up taking over Mont Blanc a couple of years ago and has really made huge progress at Mont Blanc. I think he's your next guy that runs the company. Jerome is young. He's fixed 3 businesses that have had problems. And he would be my guess as to, in the event of an untimely death, he would be who I would expect would be groomed to run the business. That would be just my guess. But
and they have a large board, which is sort of weird. I mean, they got 18 members on their board. 15 of them are non-executive, so it's a lot of people.
And it's real incestuous with Rainier, with their old company. The board has a lot of overlap with some other Rupert controlled company in South Africa. So I don't give the board personally as much thought as I probably should, and a lot of that is from my probably over-comforted view of Mr. Rupert. And I think that's a legitimate criticism.
Yeah, I'd agree.
I've heard that same criticism made of Mr. Buffett for 25 years as well.
Yeah, I mean, investing is a people business, right? So you get someone who's shown a special touch. It's usually good to stick with them.
Does anybody have any comments on sort of our valuation and how we're looking at it? Chris, Daniel?
I'll just, since I'm honestly trying to be very active in luxury. I think it's interesting from both a long and short perspective. I think it's going to be primarily a relative value situation. And you had, I think, 6 months ago, the whole group was trading under 10 times EBITDA. Now it's over, and I think it's on a quarter to quarter basis. I think it's a very, it almost behaves like small cap retail stocks. It's very reactionary to oh, this company said everything was great and this company said it was terrible. And I think that's the problem. I think Richemont isn't standout cheap on a relative value basis, but you're anniversarying a very tough operational period, which you would think at some point would normalize, and then therefore on a forward-looking basis, to Daniel's point, with the operating leverage now, something that's fairly valued can become actually fairly quickly cheap. I mean, Farah has the same thing. I mean, incremental margins are 75%. So when sales inflect, what I can't believe is actually how well they protect EBIT on the downside, given incrementals are so high. But I think it's a relative value. I think this whole space is traded in tandem with each other. You take the valuation doesn't really matter as much as like in terms of like your number, and it's much more getting the inflection of the operations correct.
Yeah, and I mean the way we think about it too is that a lot of it is sort of time horizon. If you're going to be really nervous about price risk over the next year or two, even, it could be a tough name to own. But if you're, we think of it as one of these things where it might just sort of bounce around. Maybe you get a chance to get it even cheaper if there's worse news down the road. And then, it's like 2 years does nothing, and third year it's up 60% or something. I mean, it could be that kind of, it could have that kind of, contours, and that would be fine with us. That would annualize. We'd be very happy with that. So some of it is, I think, time horizon. I mean, people like me, I think Daniel, I mean to speak for you, but I think, we think longer term about the power of the brands and the business, and we're comfortable with it in a way where I think if you're looking at it next quarter or next year, what they might earn, it's a tougher stock to own, I would think.
Yeah, I would say I have put less weight on the more recent private market multiples, those of the last 4 or 5 years, because not until recently, within the last 2 years, those private market multiples were from a very small group of buyers. They're very knowledgeable buyers. They're intelligent buyers, but they were purchased under a period when the belief that the Asian runway was going to be a high growth rate for a very long time, which I would argue drove up those private market multiples. And if you look around today at the embedded expectations from people in the marketplace, you've seen this about face on the belief that Asia is going to grow unabated 15% a year and become a large or disproportionate part of these businesses every year going forward. So I would apply some kind of a discount for the removal of the Asian hope that had been priced in those historical transactions. And I have been fooled on quite a few occasions where control businesses got sold, and I never thought they would, and they did. So I think it's a good exercise to go through and look at your library of private market comps and what the interest rate environment was at the time and what the embedded expectations were at the time for the growth rate, and then adjust your private market multiples for the changes that you exhibit today. So those multiples would be much higher today because interest rates are much lower. The multiples will be lower today because the expected growth rates are lower. I don't know what's right. I don't know that it's right, but those would be the things that I think you would make adjustments for today in that style of valuation. The thing that I think in valuing the firm is being discussed but not stated is that there is a durable franchise here that can reinvest capital at really high rates. It's not doing it right now, but it should be able to do it over a long period of time as this soft demand gets lapped, to your point, Stephen. And over time, wealth in the world grows. Reinvesting capital inside that franchise at high incremental margins is worth a lot of money. It makes this business worth more than a regular business throwing out capital that doesn't have anything good to do with it.
Where do they reinvest? Is it a lot of little incremental product categories at every little brand?
It's all in this upgrade from external boutiques to internal boutiques. If you look at this huge run up in CapEx and you tear apart, where is this CapEx going? How much is going to manufacturing, which is a lot. It's normally 25 to 30% going to manufacturing. How much is going to retail, which is normally half or more in the last few years. So it's this incremental take, to Chris Bloomstrand's point earlier, that this business has shifted to one where it's really vertically integrating and they're capturing the whole margin and still sustaining really high gross margins. So I think of it that way, as this ability to open new doors or take new doors away from the franchise partners and capture good returns on capital there.
And is there productivity? I've noticed this with Burberry, like the long thesis is that the productivity of their stores is substantially below peers. I think that's because they don't have a well-rounded brand. But have you looked at productivity on a store basis versus?
No, I haven't been able to get that.
Yeah.
I have not been able to get any of those data. And also the other point that's going to be working against them in the next year or so, deleveraging SG&A, is going to be more sales of stainless steel products as opposed to gold, where you've got higher price points, sales per foot go down. In the scenario where Vacheron's selling a steel Geneva Seal watch versus a rose gold Geneva Seal watch. There's a mix issue that's going on right now where they're trying to capture a customer that is still interested in the product but is willing to pay less. I don't know if I answered your question, Steve.
No, yeah. I mean, you don't have the data. Is it,
So
Right.
from a valuation perspective, I mean, the slides which Thompson had put out, I mean, basically earnings yield is about, just short of 5%. But that earnings yield includes CapEx at 20% ROE, which could produce, I think he was showing slides with 5% of growth. So is it fair to say that expected? Because I think
I would back out the $5 billion in net cash.
Oh yeah, he did that.
Which is going to get you a little bit higher, significantly higher earnings yield. I've got it closer to 7.5%.
Okay, but is that so? Yeah, either 5 or 7.5% plus 5% organic growth because you're reinvesting a lot of it as upgrading, or so that's the expected return on this is in sort of double digits to low double digits for a long-term holder. Is that what everyone feels about it, given the yield and the ROIC metrics?
Yeah, I mean, that's the way I would think about it. It's over the life of the thing, you've got a cash drag here, but over the life of owning a business that earns 20% return on capital and the valuation doesn't change, and they're able to reinvest, that's something where you should earn something close to that, right? It's just math. But we've got a cash drag. They're not reinvesting so much now. But nonetheless, yeah, I think a double-digit return out. If you look out 5 years and then look back, that's the way I look at it. And also, that growth rate implies a lot in pricing. I think Thompson, correct me, but I think we assumed at least 3% in pricing, just in price increases, which are usually a big driver for their revenue.
Yep.
So that's the
and also you have this offsetting drag in the business that the increased annual depreciation and increased annual rents. I would expect in the next 18 to 24 months they're going to be renegotiating a ton of leases. I would think we will hear about that, trying to get lease expense down. The leases in the owned stores are pretty peculiar because they have minimum rents and then they have variable rents based on other factors, I would assume sales and profits. But part of this idea that the business is more difficult today than it was, but for good reason, to protect it against discounting, does mean that the normalized maintenance CapEx is probably higher today than it used to be. So I have a hard time arriving without growth in the business, meaning growth in stores and growth in outlets. I have a hard time getting a steady state model to give me the kind of growth rates that I used to get from just pricing, because I think much of the pricing power at $10.5 or $11 billion, 3%, $300 or $400 million, the escalators and the leases are going to eat some portion of that. So I do worry. I worry about everything, but I do worry about the
Right.
That's great. So we can sort of, and on the downside, let's say, what are the sources of downside protection here? So we talked about the upside possibilities for a long-term holder. Downside protection, I would say, is that these are some of the brands, some percent, Baume & Mercier does not have pricing power, and but some of the brands, some percent of their sales and assets, they have huge pricing power. But in the hands of the right management, which Daniel was saying, these brands can thrive and do very well. So our downside protection here is basically it's wealth will keep on increasing and people will buy these aspirational brands, and it's in the right management team. So that's sort of the downside protection, the two sources of downside protection here.
But, in the teeth of the financial crisis, Mr. Rupert pointed out that cash is really the downside protection. They'll do everything they can to protect the brands, albeit shrinking overhead, which is a tough thing to do when you have high levels of fixed cost. But he pointed out that the cash is the cash, and with $7 billion today, they can withstand the downturn. My take is you've got a management team in place that's hell bent on preserving brand value, and that's pretty attractive. I agree with Daniel. I don't think you're going to see the same level of organic growth that you've had over the past 8-9 years, but that's okay because you've got a business that can reinvest capital, and they tend to do it intelligently at the right time. At kind of mid-teen to as high as high-teen multiples, which is wonderful. And I'm okay with far less growth than I think the sell side probably would have looked at for the last decade.
Okay, before we end, Vishal, there's just a few FX questions left on the webcast, and so basically, I'm going to summarize all of the questions as how does the company manage FX, and particularly as it relates to purchasing, but then also arbitraging. The Chinese buyers now flood into Harrods because the pound is now $1.22. And then also, does the stock move on FX essentially? Do y'all know this?
Well, when we looked at it, the currency effects, it doesn't really affect it. I mean, you can plot it against the Swiss franc or whatever you want. Again, I think it's the pricing power that allows them to, overpower the appreciating franc, which is what they have had to deal with mostly. So the currency effects in the near term, I suppose, could be more of an effect, but long term, that's something that's pretty far down the list of concerns for me. But maybe the panelists have a different take on that.
Well, the company has historically tried to hedge 70% of its year forward currency exposure. So they've been very active. Gary Assange talks about that occasionally, on actively hedging their exposure, because their functional currency and much of their manufacturing locations is the franc. And when you have the franc appreciating 25% like it did a few years ago, what that does to your operating margin is pretty ugly. But thankfully, when you look at a business with 65% gross margins, most of that cost of goods sold is in manufacturing in francs. So it's the remaining 65% that's not hit as hard from the Swiss appreciation. But I think a lot about the currency here in the short and intermediate run, primarily because what you really want is you really want a strengthening dollar because we're such a big market. And I think Richard, in one of the webcasts they did in the last year or so, actually held up a chart of exchange rates and said, "This is what I look at every morning when I wake up. If you tell me what these are going to look like, I can tell you what our business is going to be." If I remember his quote correctly, and I'm paraphrasing, so I could be wrong. But I think strong currencies out of big buying blocks is what they really want, because when the dollar's strong, they sell more. So the weakening dollar has been a problem for them over the last short period of time, and they really they do a good job of hedging when you look at the forward hedges, and they do this with inputs as well, the gold, the stones, and all the other things. But I do recall some specific discussion from the CEO of the firm about the daily things that they think about, and hedging was one of them. I may have it backwards. I don't recall off the top of my head. But if you look at the annual webcast and go to the questions section for the 16 year-end webcast, you'll find there's some reference to currency there in response to a sell-side analyst. And I remember him flapping the paper around saying, I look at every morning at these, and it was currency rates.
You know, another thing they talk about is their use of global or universal pricing to temper some of the effect of currency movements in the markets where they've got the retail outlets. And I'm not sure exactly how that works, but something they clearly address and think about.
Well, they cut prices in the United States for the first time ever.
Mechanically, how that works, how they're setting prices on a shorter term basis in different markets.
Well, in some of the high watch purchases, they will give you a daily or hourly update on your currency when you buy the watch. Some of the high jewelry is priced by the hour as well, based on the currency that you're using to purchase that product. So that they're pretty. I think they've done about as good a job as you could do, given that the world, the transfer mechanism in the world is no longer interest rates, and it's now currencies.
Great. Does anyone have any more comments or questions on Richemont before we wrap up?
I just have a solicitation, actually. I mean, if anyone has any other observations on luxury, like strong observations on other luxury companies, like if you see something, the two things on our radar screen are Burberry, where there's a new CEO coming in. It's at fairly high. I mean, their comps are negative. We think. I mean, the trench trend is off, is gone. And then their scarf saved them, and now that's gone. So they have a new CEO coming in, likely to reset guidance. But then they're underproducing. Or I'm sorry, their productivity per store is low. I think Montblanc is a really interesting, not short-term short, but Montblanc has gone. Montclair. I'm so sorry, Montclair. Montclair went bankrupt in the 90s. Montclair is another. The thing is the management is very aware that they're riding a trend that will end. You had a really warm winter last year. Really, you're probably gonna have a very cold winter this year because of La Nina. So they're probably gonna have an excellent Christmas. But those are on our radar screen, and I'd love to know if anyone else has like any interesting perceptions on long or short in the luxury space, because I think it's interesting, the sector.
Well, the only other one we've looked at is one you might know, Ferrari. But
what are your thoughts on it?
I like it a lot. Yeah, I like Ferrari. I'm a fan of old Sergio, so yeah. I mean, I think that one's probably going to look cheap 2 or 3 years out when they step up in their production.
Yeah, I mean, so EBIT's going to double in the next 2 years.
Yeah.
And also, the thing is that I think people think they're going to spend less on Formula One, which is interesting. John Malone just bought Formula One, but I mean, I think Ferrari is actually a better brand than Formula One. If Ferrari doesn't even show up to the race, no one watches Formula One, which is why they get paid to show up to the race. But one cause for concern on Ferrari near term is people think that they're going to stop spending as much on Formula One. That's not going to happen because they're really sucking wind on in the racing season right now. So they're going to probably increase their spending, their capex and R&D. Actually, it's expensed R&D on Formula One. So EBIT might not rise as quickly based upon that, but everything else looks good. Any other luxury observations? All right, cool. So Vishal, do you want to wrap it up?
Yeah, sure. So great. Thanks, everyone. Thanks, Chris and Thompson, for presenting, and on the panel, especially the Daniel West for sharing his expertise on Richemont. We really appreciate it. And the other panelists, Chris and Steve and Andrew, thank you very much for joining the discussion. We appreciate it. Thank you.
Thank you.
Thanks a
A lot
lot,
of
guys.
fun.
Thank you all.
All right.
Been awesome, y'all. Thanks.